Let's just jump in on Korea. What's happening to their trade deficit? This is, of course, right after they have opted for, not committing to another 50 basis point hike. Put that part of the puzzle together and what it means for the markets, particularly in Asia and Korea.
Well, it offers a short-term lifeline in the sense that it suggests that economic activity abroad is still picking up. But let's be realistic here. The economic activity abroad isn't really picking up. I think this could be part and parcel to a weaker currency outlook. There could be a little bit of front loading of inventories abroad here. We're just trying to figure out the exact details in what the export data was revealing. We know that China has been promoting a weaker currency to help exports. This could be along the same lines as to what Korea is currently doing also.
Well, of course, the other big headline, yen dropping below the year-to-date low. It's hit its weakest since 1998. What's going on there? What's going to happen? Do you expect this to go, keep falling?
Well, it's clearly the differentials are working in the dollar's favor, but there's also this safe haven premium where a lot of investors, let's look at the broader FX market in general here. There's a lot of focus on the energy crisis in Europe, sure, but there's this safe haven bid that's under the US dollar right now. There's a lot of flows into the US. A lot of investors, big global investors, are using the Federal Reserve Board's reserve repo facility to park money. And this is really what it's all about. That's a real safe haven. That there's absolutely no risk in parking the money with the Fed. So a lot of people are doing that, and that's driving safe haven demand for US dollars across the board right now. And I think the yen is paying the price for
it. Stephen, we're also seeing that move in the Treasury 2-year yield just creeping to 3.5% for the first time in 2007. Of course, we've really been flirting with that level for the past couple of days now, but the Treasury 2-year rising to 3.5% for the first time since 2007. I mean, is there a limit to the Jackson Hole reaction? Because we see the big moves in treasuries. We see the big moves to the downside when it comes to equities as well. And in fact, that cross-asset correlation is really something to be reckoned with. We haven't had an update for US equities since that speech in Jackson Hole. So at what point do we see investors adequately, repricing these Fed expectations?
Yeah, I think the market's entirely given up on the Goldilocks world, decent growth, moderating inflation, and even more importantly right now, a Fed pivot. But what we have to focus on is the data. We've really noticed this week that stronger economic data is being perceived by the market and being repriced by the market right now, and a hawkish Fed narrative. So as we move into the payroll data coming up this Friday, there's a possible for more pain in the equity markets if that economic data comes in strong. So reverting back, what could change that narrative is weaker economic data, of course. If the market starts to see a string of weak economic data coming out to the US, they'll bring forward those rate cuts into 2023 again that have been pushed out. Right now, they're playing the narrative on the hawkish Fed narrative. They're playing away from the Fed pivot narrative, and they're pricing in higher for longer interest rates in the US. And this is playing out quite negatively currently for the US equity markets.
Switching away from the US and Fed, because I know a lot of people are tired of talking about it, but a completely different monetary policy scenario to be found in China, right? If you take a look at our MLive Pulse question, Stephen, I'm wondering, do you find opportunities in China? Where do you see the most value in the Chinese markets right now?
Well, it's an interesting market because we're seeing easing in China, but a step up in economic activity in China is really good. Requires a combination of support for consumers, which we are seeing, a pickup in orders from the rest of the world, which we're not so sure about if we do move into that recessionary world. But more importantly, we have to see China move out of that restricted mobility situation due to COVID. We're coming up to the Communist Party's 5-year leadership Congress meeting, and in the middle of October, there's some thought here that there could be a readjustment in COVID restriction policy. This would be great for markets globally, in my view. But in the interim, I think the PBOC is content with the weaker yen, at least to the extent that it's going to encourage exports while not hurting capital outflows. So we have to keep our eye on that market. But overall, I think there's going to be some appeal for China assets, because there's a good chance we do move out of that restrictive COVID policy in the middle of October. And I think markets may start to position for that.